Tom Lee, the head of research at Fundstrat and one of Wall Street's most well-known market bulls, just made a bold prediction. He believes the biggest stock market gains of our lifetime could still be ahead of us. In a recent CNBC Squawk Box interview, Lee shared why he thinks artificial intelligence, stronger economic growth, energy independence, and several powerful long-term trends could drive stocks significantly higher over the next few years. First, I'll show you the interview clip. Then I'll break down exactly what Tom Lee said, what it means for investors, and whether I agree with his outlook. And finally, I'll reveal 3 top AI stocks that could be well-positioned to benefit if his predictions turn out to be right. Let's hear what Tom Lee has to say.
We took off in April, just like you said, and we've continued in May. So, I mean, you could take a complete victory lap. And we've got so many people that come on here that have no idea what the market's going to do near term or long term. And it just contrasting, what you do so well from time to time. You can't do it forever, though, Tom. You're going to be wrong one of these days. But you're right again this time.
I know it's been a tough market for folks. I mean, I'm not surprised. We were kind of expecting 2026 to be a year where turbulence could happen and people would see head fakes. But there's still some really powerful tailwinds for America. One is, of course, the AI story. And now we're learning about the energy independence, right? America can deal with high oil because we're not going to have a shortage of it. And then there's further tailwinds coming because as AI moves downstream, it's really benefiting American businesses. I think that's why S&P earnings came in for just the first quarter $10 higher. That's $40 for the year. And if you just put a 20 multiple, that adds 800 points to the S&P. So I think there's a lot of grounding for why stocks are able to recover. But again, I think we still might have challenges between now and December. So I think everyone still needs to be vigilant, but generally bullish.
What did you say about the next 2 or 2.5 years being some of the best market activity that we've ever seen? You still feel that way? And that was not on this show. You said it somewhere else. But what is your forecast for the next 2 years, and what's it based on?
Well, I think a couple things are coming together, Joe, that are going to really support a few things that may only happen like once in our lifetime. One is I think the U.S. economic growth rate is actually starting to step up. In other words, we could grow at 4%, and for a mature, largest economy in the world to start to accelerate growth, that's pretty astounding. The second is the U.S. is one of the biggest exporters of the most important tool in the next 10, 15 years, which is AI products. And that means we are a net, essentially, exporter of a high-value product. And there's so much capital, I think, misallocated today because so much of it is held in private alternatives, but it's going to move into the public market. So I do think that, plus the demographic tailwind of millennials and Gen Z, adding to the workforce, but then also beginning to inherit generational wealth. I think that is going to set up for after 2026, perhaps, over the next 2 years, some of the biggest gains of the stock market in our lifetime.
We just had a board. So you think, we hit 7,700 near term, and then there's a pullback, and then after the midterms, is it coincident with the midterms, the pullback, and then we had higher afterwards? Was that correct?
Yeah, I think that's. Yeah, I mean, this is our best guess. I think June markets can still build on the gains, just not at the rate that May did, and I think it is money moving downstream. So there's going to be software rallying and beneficiaries of AI, but between, let's say, June and October, we do have to digest potentially 3 major IPOs coming, and the market will try to understand Kevin Warsh's new sort of model for inflation, but I think the market always tests the new Fed. And then we have that normal seasonality around midterms. And so I think we could have a drawdown that'll feel like a bear market. And as you know, that February to April was just a 9% decline, but it felt like a crash. And so I think markets are going to really struggle if we start to have a drawdown. And then, of course, from October, I think that's when a strong a very strong rally starts.
What really stood out to me is how confident Tom Lee remains despite all the volatility investors have experienced recently. Most market commentators tend to become extremely bullish after stocks have already rallied and extremely bearish after stocks have already fallen. Tom Lee seems to operate differently. In this interview, he reminds viewers that he was bullish during periods when many investors were panicking, including after geopolitical tensions triggered a sharp market sell-off. At the time, sentiment was terrible. Headlines were overwhelmingly negative, yet he argued that the decline was largely over and that stocks would recover quickly. What makes this important is not simply that the market bounced back, it is the reasoning behind why he believed it would happen. Throughout the interview, he repeatedly returns to the idea that there are powerful structural forces supporting the American economy and stock market. In his view, temporary fears may create turbulence, but they do not necessarily change the long-term trajectory. The first major pillar of his argument is artificial intelligence. Tom believes AI is not just another technology trend. He sees it as a transformational force that could drive productivity, earnings growth, and economic expansion for years. This is where his thinking becomes especially interesting. Instead of focusing on the daily headlines about AI chatbots or new software releases, he is looking at how AI eventually spreads throughout the economy. His argument is that as AI moves from being concentrated in a few technology companies and becomes integrated into thousands of businesses, productivity increases dramatically, companies become more efficient, costs decline, revenue opportunities expand, profit margins improve. That leads directly to higher corporate earnings. He points out that S&P 500 earnings came in stronger than expected, and in his view, part of that strength is already reflecting the early benefits of AI adoption. If earnings continue rising, stock prices can justify moving higher as well. Personally, I think this is one of the strongest parts of his argument. Investors often underestimate how much productivity improvements matter. Throughout history, some of the biggest stock market booms occurred during periods when businesses learned how to do more with less. The internet created one of those periods. Mobile technology created another. AI could potentially become even larger because it touches almost every industry rather than just a handful. Another major point Tom makes involves energy. This part of the interview might not receive as much attention as the AI discussion, but it could be equally important. He argues that America's energy position is much stronger than many people realize. Historically, high oil prices often hurt economic growth because energy shortages created economic pressure, but according to Tom, the United States is now in a much better position due to its domestic energy production capabilities. His argument is that America can handle energy price shocks better than it could in previous decades because supply risks are lower. If that proves true, it removes one of the traditional obstacles that often derailed economic expansions. What is particularly interesting is how he connects energy and AI together. Massive AI infrastructure requires enormous amounts of electricity. Data centers, cloud computing facilities, and advanced chips consume significant power. If America can provide both the AI technology and the energy needed to support it, that creates a powerful competitive advantage. The heart of the interview arrives when Tom begins discussing the next 2 years. This is where he makes his boldest prediction. He suggests that investors could witness some of the biggest stock market gains of their lifetime. Now, whenever anyone makes a statement that dramatic, skepticism is healthy. Extraordinary forecasts require extraordinary evidence. But what is important is understanding why he believes this. The first reason is economic growth. Tom argues that the United States may be entering a period where economic growth accelerates toward 4%. For the world's largest developed economy, that would be a very significant achievement. Think about what that means. Large, mature economies generally grow slowly because they are already so developed. When a massive economy suddenly begins accelerating again, it creates opportunities across multiple sectors simultaneously. Businesses generate more revenue. Consumers spend more money. Employment remains strong. Corporate profits rise. That combination tends to be very favorable for stock prices. The second reason involves America's position in the AI race. Tom views the United States not just as a user of AI technology, but as one of the primary exporters of AI products and services. In other words, he believes American companies will be selling the tools that power the next technological revolution. If that happens, the economic benefits could be enormous. Throughout history, nations that dominated major technological revolutions often enjoyed significant wealth creation. Britain benefited from the Industrial Revolution. The United States benefited enormously from the rise of computing and the internet. Tom believes AI could represent the next chapter of that story. Another fascinating point he raises involves capital flows. He argues that enormous amounts of money are currently tied up in private investments and alternative assets. Eventually, some of that capital could move into public markets. If that occurs while earnings are growing and economic conditions remain favorable, it could provide additional fuel for higher stock prices. I think this is an area investors should pay close attention to. Markets are ultimately driven by supply and demand. If more capital chases publicly traded companies while earnings continue expanding, valuations can remain elevated for much longer than many people expect. Tom also introduces a demographic argument. He points to millennials and Gen Z entering their prime earning years while simultaneously beginning to inherit wealth from older generations. This is a very important long-term trend. When younger generations accumulate income, invest for retirement, purchase homes and inherit assets, a tremendous amount of capital enters the financial system. These demographic shifts unfold slowly, but they can influence markets for decades. In many ways, Tom is arguing that several powerful forces are converging at the same time: AI, energy, economic growth, capital reallocation, demographic expansion. Each factor individually could support higher stock prices. Together, they form the foundation of his extremely bullish outlook. However, one thing I appreciate about this interview is that Tom is not claiming the path will be smooth. Even while expressing optimism, he warns investors about potential turbulence between now and the end of the year. This is where many viewers may miss an important nuance. Being bullish does not mean believing stocks go straight up. Tom specifically discusses the possibility of a meaningful drawdown between the summer and fall months. He points to several potential catalysts, including major IPOs entering the market, uncertainty surrounding Federal Reserve policy, and historical midterm election seasonality. What caught my attention was his observation that even relatively modest corrections can feel much worse emotionally. He references the earlier decline that was only around 9% but felt like a crash to many investors. I think this is something every investor can relate to. When markets are falling, emotions amplify reality. A normal correction suddenly feels catastrophic. Investors begin questioning their strategy. Financial media becomes increasingly negative. Social media turns into a sea of panic. Yet historically, those periods often create the best long-term opportunities. Tom seems to be suggesting that if another correction arrives, investors should focus on the bigger picture rather than getting lost in short-term fear. The interview then shifts toward cryptocurrency, and this section is particularly interesting because Tom acknowledges some of the frustrations crypto investors have experienced. He agrees that cryptocurrencies have not performed the way many supporters expected recently. While software stocks and AI-related companies have surged, crypto assets have lagged behind. That has led some investors to abandon the space entirely. Tom refers to this as a form of capitulation, where investors become so frustrated that they sell near the end of a difficult period. Despite the disappointing performance, he remains convinced that the long-term thesis for Bitcoin and Ethereum remains intact. His reasoning goes beyond simply viewing Bitcoin as digital gold. Instead, he frames crypto as infrastructure for the future digital economy. According to Tom, as AI systems become increasingly autonomous, society will need reliable methods for identity verification, ownership verification, decentralized transactions, and digital trust. Blockchain networks could potentially play an important role in enabling those functions. Whether or not one agrees with that vision, it is certainly a broader framework than the traditional argument that Bitcoin is merely an inflation hedge. Personally, I think this is where the debate becomes especially interesting. The success of crypto may ultimately depend less on whether it replaces gold and more on whether it becomes integrated into real-world financial infrastructure. If tokenization, decentralized identity systems, and blockchain-based settlement become mainstream, the value proposition changes dramatically. Tom also discusses valuation methods for crypto. Many critics argue that cryptocurrencies cannot be valued because they do not generate traditional earnings. Tom pushes back on that idea by pointing to network effects. His argument is that as more people use Bitcoin and transaction activity grows, the network becomes more valuable. This mirrors how analysts evaluate other network-based businesses. He also compares Bitcoin's scarcity and potential value to gold, suggesting that if Bitcoin eventually captured a similar store of value role, its long-term upside could be substantially higher than current levels. Whether that scenario unfolds remains uncertain, but it highlights just how optimistic Tom remains about the future of digital assets. Stepping back and looking at the interview as a whole, the key takeaway is not any single prediction. The bigger message is that Tom Lee believes America is entering a period where several rare economic forces are aligning simultaneously. He sees AI driving productivity, energy independence supporting growth, demographics creating demand, capital flowing into public markets, and technological leadership strengthening America's position globally. Of course, forecasts this ambitious will always have critics. Markets rarely move exactly according to anyone's roadmap. Unexpected events can change the outlook quickly. But what makes this interview compelling is that Tom is not basing his optimism on a single indicator. He is building a case around multiple long-term trends that reinforce one another. The real question for investors is whether these forces are powerful enough to overcome the inevitable volatility, corrections, and uncertainty that will occur along the way. Tom clearly believes they are, and if he is even partially correct, the next few years could look very different from what many cautious investors currently expect. Now let's dive in and talk about 3 top AI stocks to buy now that could potentially benefit from one of the biggest technological shifts in modern history. Let's begin with the first stock, ServiceNow, ticker symbol NOW. When most investors think about artificial intelligence, they immediately picture chatbots, image generators, and large language models. What they often overlook is the software infrastructure that allows businesses to actually deploy, manage, and coordinate these technologies across an entire organization. That's where ServiceNow comes in. ServiceNow has quietly become one of the most important enterprise software companies in the world. Its platform helps organizations manage workflows, automate tasks, coordinate departments, and streamline operations across complex business environments. Think about a large corporation with thousands of employees, hundreds of software systems, and millions of daily business processes. Without a centralized system connecting all those moving pieces, efficiency breaks down quickly. ServiceNow serves as that central nervous system. And according to one surprising source, that role may become even more important in the age of artificial intelligence. One of the most interesting developments surrounding ServiceNow recently came from Anthropic's AI model, Claude. While many investors worry that AI agents could eventually replace parts of traditional software businesses, Claude actually took a very different view. The bearish argument against ServiceNow is straightforward. Some investors believe that as AI becomes more powerful, intelligent agents may perform tasks directly, reducing the need for workflow software platforms. At first glance, that sounds logical. If AI can complete tasks on its own, why would businesses still need software platforms to coordinate those tasks? But Claude argued that this concern may be overstated. In fact, the AI model suggested that ServiceNow could become even more valuable because AI agents still need a control center. Businesses need systems that connect departments, manage permissions, coordinate workflows, and ensure processes operate correctly. In other words, AI agents still need infrastructure. They still need a platform that tells them what to do, where to get information, and how to interact with other business systems. ServiceNow already sits in that position today. That creates a fascinating possibility. Instead of AI replacing ServiceNow, AI could actually increase the importance of ServiceNow. The company's Now Assist platform provides another reason investors are paying attention. Rather than cannibalizing its existing business, ServiceNow has been integrating AI capabilities into its platform and monetizing those features through additional seat pricing. That means customers who want enhanced AI functionality often pay more, creating a potential new revenue stream while preserving the strength of the core business. This distinction matters. Many technology companies face disruption risk because new technologies replace old products. ServiceNow appears to be taking a different path by embedding AI directly into its existing ecosystem. That approach could allow the company to benefit from AI adoption without undermining the business model that made it successful in the first place. Another reason investors continue to watch ServiceNow closely is its massive growth opportunity. The company's leadership recently stated that reaching $30 billion in subscription revenue by 2030 represents what they consider their bear case scenario. Think about that for a moment. A bear case is typically the conservative outcome. Last year, ServiceNow generated approximately $12.8 billion in subscription revenue. To reach $30 billion by 2030, the company would need to more than double its subscription business over the next several years. That is an ambitious target, yet management is presenting it as the lower end of expectations rather than the optimistic scenario. Whether they ultimately achieve that goal remains to be seen, but it illustrates how much confidence leadership has in the long-term demand environment. One reason for that confidence is the company's economic moat. ServiceNow is deeply embedded within customer operations. Once a large enterprise integrates ServiceNow into its workflows, switching to a different platform becomes expensive, time-consuming, and operationally disruptive. That creates strong customer retention. It also gives the company opportunities to expand relationships by selling additional products and capabilities over time. Investors often underestimate the power of software businesses that become mission-critical to their customers. When software becomes essential to day-to-day operations, customers are far less likely to leave. That creates recurring revenue streams that can compound for years. And recurring revenue is one of the most attractive characteristics investors can find in a business. Another factor attracting investor attention is valuation. Even though ServiceNow remains a premium software company, some analysts believe the market has already priced in many of the concerns surrounding AI disruption. According to recent analysis, ServiceNow currently trades at roughly 18 times projected fiscal 2027 earnings. To understand why that matters, consider the historical context. Its 5-year average valuation has been closer to 35 times earnings. Meanwhile, many comparable software-as-a-service companies trade around 25 times earnings. If those numbers are accurate, investors may be looking at a company whose valuation has compressed significantly, despite continued growth opportunities. Now, valuation alone never guarantees investment success. A stock can always become cheaper. However, when a strong business trades below historical valuation levels while maintaining growth potential, long-term investors often take notice. Another encouraging sign comes from professional investors who continue viewing ServiceNow as an AI beneficiary rather than an AI victim. Some investment managers have argued that companies controlling mission-critical software environments may actually benefit from the rise of AI agents. Their reasoning is straightforward. If AI agents need access to critical business systems, software providers may eventually monetize AI users similarly to how they monetize human users today. That could create entirely new revenue opportunities. Imagine thousands of AI agents interacting with business software around the clock. Those interactions have value. Companies controlling the platforms where those interactions occur could be positioned to capture part of that value. This is one reason many investors believe ServiceNow remains uniquely positioned in the AI era. The company is not trying to become the next chatbot. It is not competing to build the largest language model. Instead, it is focusing on something arguably more important. It is building the infrastructure layer that allows organizations to operate effectively in an increasingly AI-driven world. And infrastructure businesses often become some of the biggest winners during technological revolutions. History provides countless examples. During major technology transitions, the companies providing essential tools and infrastructure frequently generated enormous shareholder value. ServiceNow appears to be pursuing a similar strategy. The company benefits whether businesses automate 10 processes or 10,000 processes. As adoption increases, demand for coordination, governance, workflow management, and enterprise integration may increase as well. That's why many investors continue viewing ServiceNow as one of the most compelling enterprise AI opportunities available today. The risks certainly exist. Competition remains intense. Execution matters. Economic slowdowns can impact technology spending, and no investment is guaranteed to succeed. But when you combine recurring revenue, a strong competitive moat, growing AI monetization opportunities, ambitious long-term revenue targets, and a valuation that some believe already reflects many investor concerns, it's easy to understand why ServiceNow continues attracting attention as a potential long-term AI winner. For investors looking beyond the headlines and focusing on the infrastructure powering artificial intelligence adoption, ServiceNow may be one of the most important companies to watch over the next decade. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Our second AI stock is one that many retail investors still haven't heard of, yet it has quietly become one of the market's biggest winners this year. Nebius, ticker symbol NBIS. If ServiceNow represents the software infrastructure layer of artificial intelligence, Nebius represents something equally important, the physical infrastructure powering AI itself. One of the biggest mistakes investors can make is assuming the AI boom is only about chatbots and software applications. Every AI model requires enormous computing power behind the scenes. Those calculations need to happen somewhere. They require specialized hardware, data centers, networking equipment, storage systems, and massive amounts of electricity. Without that infrastructure, artificial intelligence simply doesn't work. and that's exactly where Nebius has carved out its opportunity. The company owns and operates AI-focused data centers and provides clients with a full-stack AI infrastructure platform. In simple terms, Nebius gives companies the computing resources they need to build, train, and deploy AI models without having to spend billions of dollars building their own infrastructure from scratch. Think about how many businesses want to participate in the AI revolution today. Thousands of companies are experimenting with AI initiatives. Some are building internal models. Others are creating AI-powered applications. Many are looking for ways to automate workflows and increase productivity. Almost all of them face the same challenge. They need access to computing power. The demand for AI infrastructure has exploded over the past few years, and Nebius is positioning itself directly in the middle of that trend. This is one reason why the stock has delivered such extraordinary performance recently. Shares have surged approximately 170% so far this year. For many stocks, a move like that would immediately raise concerns that investors have missed the opportunity. But the interesting part of the Nebius story is that its underlying business growth has been even more impressive than the stock's performance. In the most recent quarter, Nebius reported revenue growth of 684% year over year. Let that sink in for a moment. 684%. Those are the kinds of growth numbers investors rarely see outside of the earliest stages of a major technological shift, and management believes the growth story is far from over. Wall Street analysts currently expect revenue growth of approximately 550% this year, followed by another 219% growth next year. Now, whenever investors see growth numbers this large, an important question immediately comes up. Is this sustainable? That is the key issue every potential Nebius investor must consider. The answer depends largely on whether AI infrastructure demand remains as strong as it is today. At the moment, there is little evidence suggesting demand is slowing. In fact, many industry observers believe AI computing demand is still in the early stages of expansion. Businesses continue increasing AI spending. Developers continue building more sophisticated models. New AI applications continue emerging across industries. And each new generation of AI systems requires greater computational resources. This creates a potentially powerful tailwind for companies operating AI infrastructure. One of the reasons Nebius stands out is that it offers more than just data center space. The company provides a complete ecosystem designed specifically for AI workloads. That matters because artificial intelligence workloads differ significantly from traditional cloud computing tasks. AI training requires specialized hardware configurations, optimized networking, and software environments specifically designed for machine learning operations. Companies that can provide integrated solutions may enjoy significant competitive advantages as AI adoption accelerates. Another aspect of the Nebius story that investors should pay attention to is market share. Management appears focused on aggressive expansion. Rather than maximizing short-term profitability, the company is investing heavily to capture customers and establish itself as a major player in the AI infrastructure market. That strategy comes with risks. Rapid expansion often requires substantial capital expenditures. Profitability may remain limited while growth investments continue. Execution challenges can emerge when companies scale quickly. And investors should always remember that high-growth companies frequently experience elevated volatility. But there is another side to that equation. When a company operates in a rapidly expanding market and successfully captures share early, the long-term rewards can be substantial. Many of the biggest investment winners in history looked expensive, risky, and unprofitable during their early growth phases. The key question was never whether they were profitable at that moment. The question was whether they were building a durable position in a market with massive long-term potential. That is the lens many investors are using when evaluating Nebius today. What makes the opportunity particularly interesting is that artificial intelligence demand is not dependent on a single customer or industry. Healthcare companies want AI. Financial institutions want AI. Manufacturing firms want AI. Retailers want AI. Media companies want AI. Government agencies want AI. Virtually every sector of the economy is exploring how artificial intelligence can improve productivity, reduce costs, or create new products and services. That broad demand base could provide Nebius with multiple avenues for continued expansion. Investors should also remember that Nebius remains a relatively young public company compared to many established technology businesses. The track record is shorter, the margin for error is smaller, and expectations are already elevated following the stock's impressive performance. The company may not yet have the household recognition of larger technology names, but its combination of explosive revenue growth, strong industry tailwinds, and exposure to one of the fastest-growing segments of artificial intelligence makes it one of the most intriguing AI stocks in the market today. Of course, investors must balance opportunity against risk. Rapid growth stocks can generate enormous returns, but they can also experience significant volatility along the way. Position sizing, diversification, and careful research remain essential. Still, if you're looking for a company that offers direct exposure to the infrastructure powering the AI revolution, Nebius may deserve a closer look. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Our third AI stock brings everything full circle. Meta Platforms, ticker symbol META. When most people think of Meta, they still associate it with social media. Facebook, Instagram, WhatsApp, Threads, but that framing is becoming outdated. Meta is no longer just a social media company. It is becoming one of the most important artificial intelligence companies in the world, quietly using AI to transform how digital advertising works, how content is delivered, and potentially how intelligent systems will interact with consumers at scale. And the financial results are already reflecting that shift. In its most recent quarter, Meta reported revenue growth of approximately 33% year-over-year. For a company of its size, that level of growth is significant. Large technology companies typically struggle to maintain double-digit growth, yet Meta is accelerating at a pace that would be impressive even for mid-sized companies. The key driver behind this performance is artificial intelligence. Meta has been heavily investing in AI systems that improve ad targeting, increase engagement, and optimize conversion rates for advertisers. In simple terms, AI is making Meta's core business more efficient. When advertisers spend money on Meta's platforms, they want results. They want clicks, conversions, and measurable returns. AI helps Meta deliver those outcomes more effectively, which in turn encourages advertisers to spend more. This creates a powerful feedback loop. Better AI leads to better ads lead to more revenue funds further AI development. This cycle is one of the most important competitive advantages Meta currently has. But what makes Meta especially interesting as an AI investment is not just its current business performance, it is the optionality it has for the future. The company has openly discussed its ambitions to develop advanced AI models and integrate them across its entire ecosystem. That could include personalized AI assistants, content generation tools, and new forms of digital interaction embedded directly into its apps. Consider what Meta already controls: billions of users, global distribution across multiple platforms, deep engagement data across social interaction, messaging, and content consumption. Very few companies in the world have access to this level of real-time behavioral data at scale. That data becomes incredibly valuable when training and deploying artificial intelligence systems. It allows Meta to refine recommendations, improve user engagement, and potentially build AI systems that feel more personalized than anything currently available. From a financial perspective, Meta also stands out because of its valuation. Despite its scale and profitability, the stock is currently trading at less than 20 times forward earnings. For a company with double-digit growth and significant AI exposure, many investors view this as relatively inexpensive compared to historical norms for high-quality technology companies. But valuation alone does not tell the full story. The real question is whether Meta can successfully transition from being primarily an advertising platform into a broader AI-driven ecosystem. There are reasons to be optimistic. Meta has already demonstrated that AI can materially improve its advertising business. Ad impressions and conversions have increased, supported by AI improvements in targeting and content ranking. The company is also aggressively investing in AI research and infrastructure, signaling that management views artificial intelligence as a core strategic priority rather than a side project. However, there are also challenges. Meta operates in a highly competitive digital advertising market. Regulatory pressure continues to be a long-term consideration, and the company must constantly innovate to maintain user engagement across its platforms as consumer attention shifts over time. Still, Despite these risks, Meta remains one of the clearest examples of an established company successfully integrating artificial intelligence into an already massive business model, and that combination of scale plus AI leverage is exactly what many long-term investors are looking for, because unlike early-stage AI companies that still need to prove demand, Meta already has demand at global scale. It simply needs to continue improving how effectively it monetizes that demand. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.